Everyone to Inside Traders. I have a story for you guys today through my trading efforts about how I accidentally burned an opportunity by making a classic behavioral mistake while trading. But yeah, welcome to the show. My name is Caleb. I am your host. And on this show, we talk about the options order flow, which is this. And it's basically what companies are people buying and selling every day. And we try to use that as an indicator with stuff like charts and our own kind of like ideas on how to not do this, but how to make profitable trades and really profit from the real-time information coming out of the order flow and the price action of markets, and using that to try and do a couple of arbitrages just for fun, not because we need it, although we do, but mostly because it's fun and interesting. And so, yeah, I have some trades to show you guys. But before we go into that, just to give you a preview, because I think it's very useful, we can look at the order flow. So lots of puts going into Disney recently. I always wonder where this is coming from. Like, are the same people cycling them? Are there like new Disney haters being born every day? Like, is Frozen that bad? I never saw it. Like, what is wrong with Disney? Maybe that's hedging actually from a sharp rise. Now that I'm looking at this, I wonder what time those came in. Let's see the tape actually. Go here to Diz. So 3 p.m. Where's 10 million a premium. Wow, that's a lot. So that's just one person. You can kind of filter that out. Going back to who's getting bought and sold. You can literally just take note of these names and it will help you in your trading, for real. Tesla was such a perfect setup today, and a real trader would have known just how to play it. I did okay. We'll talk about like whatever mistakes I made in trading in a bit, but it was perfect. So you have this gap up in the morning, and then you have like this peak at 175, which is like kind of obvious, right? 275. Like, that's a good time to hedge. And so people do hedge. And we go all the way down to, what is this candle? 268.11. And that turns out to be the low of the day. Now, I don't know how you would have known to buy this. Like, you could see, because this would be scary going into this, right? Like, if you don't have any of this price history here, all you're seeing is a continuous lower lows. So how would you have known to buy 268.65? Might be 268.11 actually. Let's see if that is super obviously aligning with anything. Just kind of here, whatever that zone. But yeah, how would you have known to buy at 268.11? I don't know. Maybe you wouldn't have. Probably most people didn't. But you would have known to buy a second after that, because the order flow definitely reflected the change. Okay, where are we? So yeah, that was a low, 268.11. And then it was just perfect. Every low was a higher high, or like all the new lows were higher than the previous. And so you could get this increasing confidence as the day went on. Although not really, it depends. Like, probably at the 5 minute, you see it much clearer. No, not really. That's not so clear. Or is it? Look, let's see. Let's look at the actual lows on the candles. Okay, so here's the low that I'm talking about. On the 5 minute, it's still 268.11. And then our next low that's really lower is 269.98. So just barely penetrating 270. So that means there's strong buyers at 270. And then we saw that same low a click further. So that means that there's either not a ton of sellers at these levels, or there are a ton of buyers. And I don't know which, but like I guess the volume bars would tell us. I don't know. They're useful sometimes. So like, yeah, pretty freaking bullish on Tesla. So you got the Morgan Stanley upgrade. Isn't that a character from The Office? You got the price target set to 400. So like basically double, if you know, that's how people are going to think of it. Not really, but a lot higher. And it's Tesla, and it's one of the most shorted stocks in the market. So feels pretty safe to buy anything that's heavily shorted to me, because they're not going to like get popped like a fresh souffle. They've been tested, they've been tried. So that's where Tesla's at, and I think it's pretty cool. So I'll talk to you about my trades. I was trading the 280 contract today, which is kind of it highlights a couple things. I'm really trying to get better at trading these 0-day contracts, because they're the most fun, but they'll burn you. They'll burn you so fast. And so the price can just change, like it can double or fall in half at any moment, literally. And so you have to play it in a way where you're really aware of that. And the way I am currently attempting it is kind of by like cost averaging over 4 plays. Okay. So here's how it works. I pick out kind of a spread trade. So what is the high that I think is going to happen? What is the low that I think is going to happen? And by is gonna, I mean possibly could. And then I will buy calls and puts appropriately. But for each of the, I have a system that if I can predefine the contract, I can execute quickly. And so I pick out 4 contracts, a main call to buy, a sub call to sell, a main put to buy, a sub put to sell. And it turns out to be really important to have these like sub puts. And by sub, what I really mean is a little bit further out of the money, maybe like a couple of clicks, just depends on what you're thinking. The further out of the money you go, the less impact selling that call will have. And you might want less impact because you want to stack higher volume, meaning through cost averaging, or you just don't want to extract that much value equity out of your main calls, which are collateralizing that sold call. And so this is all using stuff I didn't even know existed a month ago. Like a year ago, I didn't even know you could do any of this shit. But like for sure 6 months ago, for sure 3 months ago, I didn't know that you could use your equity in one part of the chain as collateral to do other operations. It's incredible. It's a miracle. It's a miracle. Find like the option market, the modern day option market is incredible. And so yeah, like usually when I'm trying to, this is the current way I'm doing things. And that's because I got burned so hard just doing like naked calls and puts, because the price changes too quickly. And so you need a way to extract equity without changing your cost basis, and also just to really quickly extract equity. So then you could do these double plays. So like a double play would be like I sell a call, like the trade is going against me. I'm basically watching the value of the contracts go to zero, and just like a meaningful amount or whatever, you know, like for my portfolio or whatever. And these numbers are all randomized, but through a little, you know, if I made all this, obviously I can randomize it. So like, don't worry about that. But directionally it's correct. So the what was I trying to tell you? Oh yeah, why it's so important to have inverse equity is so that you can profit from both sides of the trade, because you don't know what's going to fucking happen. Nobody knows for sure at all. And so what my setup allows me to do, and what anyone could try, is, so like, let's say you think the upper end of Tesla is 280, you think the lower end is like 240, 250, something like that. That's even like too wide of a spread. I would say just kind of like look at what other people are buying and selling. And so you can just look at the volume on an option contract and like see what other people are doing. And generally that's the right thing to do. Like, you don't want to be out in no man's land or whatever. Now, why is it so important then to be able to exit equity? It's like I said, it's because you don't want to disrupt your cost basis. So here's kind of like the idea. The day opens and I am monitoring the tape. And let's just play Disney, play by play, right? Here's what I would have done. I would have opened the day with basically, see, Disney's like not a risk thing. This is like an ownership thing. We got to look at like NVIDIA. Like, where are people pumping in premium? NVIDIA is a good one. Yeah, perfect. So these options all expire on Friday. So we know that they're not planning on holding these. They're purely just trying to scalp some premium. Or maybe they're going to hold them until Friday and roll them or whatever. But still, like, these aren't long-term. They're scalping. They're trying to, like, I don't know what they're doing, but like, they're buying contracts that are about to expire. I know what I'm doing. I'm trying to compress 5 years of price action into one day, which is basically what can happen. Maybe not 5 years, but probably 5 weeks for sure into one day. Yeah. You can compress 5 weeks of price action, because guess what? That's how option contract prices work. So like, if you consider theta decay, let's say you have a contract that expires in 9 months, and 3 of those months, that will be proportionally equal to the first 3 hours of trading on Friday. So the whole 3 months of the contract would be the same theta decay by, I don't know if it's like nominally the same. I think it's more like proportionally the same. I don't even know if nominal is the right word, but I don't know if it's like the same dollar amount or if it's just the same proportion. But that's how all the contract prices work, is like, they're really magnified by what impacts them. So like, if it's Vega, it's volatility. If it's Delta, it's everything. If it's like Gamma, it's moneyness. If it's Theta, it's time. And is Gamma moneyness? I think so. If it's Rho, it's interest rates. And anyway, whatever. Like, all these different things go in to set the price. So now here's what's so crazy is, like, this could never happen with stocks. This is an opportunity only available in options because of how the pricing works, how the contract pricing works. It's a side effect of the option contract pricing. And I don't think it was probably known or thought that it would be used like this. But one of the things I just discovered, in playing with the markets, is that almost all the volume of the trades that happen isn't through stocks in the market, it's through options. And then all of the volume of options is coming from options that expire in less than 30 days. And then the majority of that expires this week. And then the majority of that expires on Friday. Like, that's when people get into it or whatever. I don't know if that last statement is true, but everything else is true. I think people, I highlighted Friday because that's going to be the most volatility. So just think about that. Like, people aren't trading stocks. They're trading options. They're trading high leverage derivatives, probably on margin. Why? Well, it's because if there's two things that any man can make use of in this world, or woman, or child, infant, monkey, any ambidextrous four-limb quadruped that can manipulate and think, manipulate matter and think, can take advantage of amplification and leverage. So like you got a giant lever and you're going to hoist up a rock, and you could never move it unless you had the lever. And what's a good metaphor for amplification? It's like if the lever could like grow more levers or whatever. Yeah. Like somehow the lever like can expand infinitely, and just like you get like a longer lever, it like you're lifting like a planet-sized object with like a needle or something. Anyway, I don't know. I'll have to think on those metaphors a little bit more. But I think that's why people are trading these options that expire, is because maybe they don't think of it in these terms, but this is how it is that you're compressing literally time. You're compressing time. And so all of the market action of the price of that options contract is going to be reflected in that day. And also it has a ton of other conveniences. Like it's all the information is already baked into the price of the contract. And so there's way less unknown, so much less unknown. And what remains is just like the true value of the contract, which is basically like, what's the probability it's going to expire in the money? And that is going to change wildly in the last 2-3 weeks of trading. And it's going to be real wild on the last day. So like, you buckle up for that kind of volatility if you want to play with these, because it's scary shit. It'll burn you. And that's why you cannot, like I think one of my fundamental mistakes that I made when I first approached these was I approached them with like, the idea was I would balance the trade always with positive delta, but just expressing a different price direction. Well, that's dumb for a few reasons. First of all, like both options can expire out of the money, and theta decay is going to ramp up so fast. Like today is the day, Wednesday's the day. So today we could just show it. Like if we look at the Tesla options chain, it's going to be really clearly red and green on the prices. Just depends on what's in the money. Whereas that's not the case elsewhere. Is it not the case today? Okay, so we're not quite there. Okay, here's where we are. Can you see that? Should be able to see that, right? So see how these are red? If we go up, they're all red, and then they change to green. Right there, right there. And that's the dividing line. And then, so this is Wednesday. Interesting though, because Tesla had a bullish day, that there are still some green contracts out of the money. 3 clicks right now out of the money is still green. Most, I think, times it's like just red and it's very clearly red and green by now. So if you don't know what that means, I'm just telling you how the pricing of these contracts work, is that like the dynamics that control the price are greatly exaggerated on the final days of trading, such that a almost literal compression of time occurs, and you can have a move in the price that you wouldn't see if you held that contract for a year. You wouldn't see that much of a movement. Well, that creates a ton of opportunity, because if you want to do an arbitrage, there's lots of different arbitrages out there or whatever, but my favorites would be time and volatility, because they're so consistent and you can count on them. And volatility arbitrage is like, well, let me talk about time first because it's easier. Time arbitrage is let me sell a call in 2025 that I know is going to eat into my returns of my shares, which collateralizes the call. But I don't mind that because I'm going to use the premium to offset both of my short-term risks to the downside and the upside. And I'm also going to use it to hedge my long-term risks when appropriate, depending on where you are in the price. So like, let's say you sell a call at all-time highs and you net a juicy premium. That's like 30% of the total value of the shares. So let's say the shares is a big chunk. You got 100 grand in that each, in Magic Corp, each share is $1,000. And so 100 of them is 100,000. And so by selling this call, you're going to net a premium of 30% of $30,000 of real cash. You could go buy a car with it. People would be like, what? Well, how'd you get the 100 grand in shares to begin with is the real question. Like, that's the hard part. But anyway, so you get this premium. And then, so now you've capped your upside. Well, hell, you might have wanted to cap your upside if there isn't any left. Like that might be a perfect arbitrage. That's also a volatility arbitrage because the vol is going to fall if it really is. Well, actually, no, the volatility falls in a bull market, but the vol is going to crush. It's going to crush. And the price is going to collapse basically. And so like a few things happen there. You got to slow it down. Like we got to break it. We got to talk about it piece by piece. So you owned 100 shares of Magic Corp and each share is worth $1,000 because we want to be Berkshire Hathaway. And when you sold a call at the peak of $1,000 per share, you netted, like into your account was deposited $30,000 of real cash because you sold it close to the money and you did that because you don't want a ton of volatility and it's more profitable. And the risk is that it enters the money, and that's not part of this discussion, but it's a risk. There's always a risk. There's no free lunch. There's a risk to the upside and the downside. And so, but there's a risk arbitrage. And so like you have the 30 grand. What do you do with that 30 grand? Well, there's so much you can do with it. Like you could buy other equities. You could just like save it for if you're right and there is a decline, then you can buy back that same sold call for a profit. And then that's just cash that you keep. You could offset the negative delta that you just added to your portfolio with positive delta. You could use it to hedge in case of a flash crash, right? Guess what you're going to be real happy with if like the aliens invade? Sold calls. Like your puts, yeah, they're pretty good. They have to get activated. Like puts don't get activated until they're at the money, kind of. And you can lose value on a put if the volatility collapses. And so what I think offers infinite protection because you have to take on unlimited risk to get this, is sold calls. That gives you infinite insurance, and not infinite, like it's the value of the sold call. So like whatever the value of that is, that's the actual dollar value that you could extract from the trade. But still, just like in terms of like you get the same momentum of calls that is so amazing, but that can also work against you. Like if you're holding on to like languishing calls, they're down like 80% in value. They're all just time value left or whatever. And you don't want to sell them, but they're like, you're just holding on to them and waiting for them to expire or whatever. And first of all, there's tricks you can do even then to exit some equity. If you really believe that's what's going to happen, you can always exit some equity. But what was I thinking about sold calls? Well, I was just generally describing the risk to the upside and the downside with everything, but sold calls actually give you this awesome downside protection, and they're a great form of insurance. And I think they're the best form of insurance because it's free. In fact, they pay you. They pay you to manage the risk. So yeah, like what do you do with that risk? I mean, you could like offset the delta by buying positive delta, and that expires in like a month. And in that, you could actually do a time arbitrage where you're buying no intrinsic value, like way less intrinsic value, and you're still getting the same exposure or more exposure to a similar level of delta. So that's a good arbitrage. But like people would say, don't sell calls because like nothing is worse than a call that's like, you can have a call that's like 200% loss or whatever. It's unlimited losses. And one day you do have to buy those back. But you don't have to worry too much about it unless you're selling naked calls, which is like insanely dangerous, which means you're like borrowing and borrowing and borrowing. And so I'll do it one day when I'm feeling very confident and ready for it. But essentially, there's nothing collateralizing the loan, the selling of the call, and the contract. There's nothing collateralizing the contract. And so if the contract moves against you, you're going to have to come up with additional collateral. And like you really actually do have to come up with that collateral. And so the nice thing about always selling covered calls is you're just selling them against your shares. And so you don't have to worry about collateralizing. Like you're solid on your shares. So yeah, that's kind of like why I like sold calls as insurance versus puts, is because they're free and in fact they'll pay you. But why they're paying you is because you're managing a ton of risk now, and you have to be real careful with what you do with that premium. If you waste it, you're going to get locked in the box. Those shares are dead. If you bought those shares on margin, now you're paying a margin cost for dead shares. It's not good. So you got to be careful. But that's all kind of like, this is actually does all tie in together, because if there was an ultimate arbitrage, right? If there was an ultimate arbitrage, it would be to sell the juiciest premium in furthest into the future possible, like 2025 right now, and then use the entire premium, like the whole thing. In this magic scenario, you're not going to mess it up or whatever. Use the entire premium and deploy it into this week's expiring calls. And in the money, like do even just buy a delta of 99. That's not a bad idea. I actually have done that and it worked very well. But it's dangerous because like if there's a big move down, that delta 99 changes real fast. And so you can't again, these premiums, you have to be careful with them. And so, but that would be quite an arbitrage, is taking all the extrinsic value represented in that premium. And then if you were right on the price direction, well, how would you be right? You could, for example, look at the order flow and see what the smart money is doing. So all day they bought green on NVIDIA. I haven't even looked at the chart, but what do you figure it looks like? Do you think it's going to go down to the right, or do you think it's going to go up? Oh, it went down to the right. But all right, I'm wrong. Bad example. Well, okay, no, we had to look at more time. I was right, kind of. Where does it start? Okay, so let's go through. Let's do the play-by-play on this. So you come to this screen right here. And then I go to chart here and close that. So on the chart view, we start the day Wednesday. And, oh, wow. So tons of calls into open, which is what we see. This first one is a put. But then we see all these calls, and until around 10 a.m. is where we start seeing puts. And that must be like right here. That must be like 8 for me, yeah. Okay, so then we start seeing all these puts, and that brings it down to here around, it looks like we see call. Oh shit, you can't see what I see. Damn. Well, the put wall was right here. So this is the put wall. And then I was trying to see the timestamp. So at 8:20, that's when we see this call. So let's go back to the tape. That should be 10:20 for us. Okay, so this is all that put wall. Okay, that's all that put wall. 10:20 for us, we start seeing green. We see it green. Okay, so see how this works? And so now it's just like super freaking green all day long. And we barely see a put until 12. So that should be at around 10 my time, chart time, which is right around where 12. It should be 10:47. 10:47. Kind of something there. There's a little bit of red. But if you look at the tape, there's not that much put, right? There isn't a ton of puts. And then it's just like green, freaking bullish, green all day long. Now, what's interesting about that is the price still goes down. Like with all that green, you still see this price move down from 258 to 252, which is essentially a give back of all the early morning greens. But it's definitely a higher high for the day. And what was the close? So the close is very bullish. So yeah, I think that's pretty useful, is to like just see how often this stuff connects with the timestamps. We could do the same thing with Tesla. I just did it already today, so I don't want to do it again. But I think you also just get the idea. You can compare the tape and the charts, and in general, you can find these correlations. Yeah, the only other thing I think I wanted to talk about today, besides the dark pools, you guys want to go look at them? No. Okay. We don't have to this time. The only other thing I wanted to talk about was the importance, if you're going to be messing around with 0 days of reaction time. So however you do that, if you stay tuned to this channel, I might give you a product you could buy maybe one day. The other side is to buying a debit is selling for a credit. So you can buy for a debit, and that means that cash is coming out of your account and you just bought something, or you can sell for credit. Now, sometimes you have to consider that it's called the effect of the trade. Like, what kind of an effect is this trade going to have on your position? Like if you're buying a debit, that means you're opening a position. So you've just opened a new position. And but you can also sell to open, which gives you a credit. It's really important to think about this stuff, because like when you sell to open, that creates inverse delta. I know that I can do a better job of explaining this simpler. So like if you're buying a call or buying a put, that option contract is going to have positive delta, even though they're betting on opposite price directions, right? The put is going to increase in value if the price goes down. The call is going to increase in value if the price goes up, but they both have positive delta. So in the case of expiring options, let's say you want to buy both options out of the money, which I think they call a strangle, which I think I like more than a straddle. Or no, I think that's a straddle. One of them. Strangle is in the money. I don't know. Doesn't matter. I like buying them out of the money because they're more reactive, and so the price moves faster. But that's also very dangerous because the price can move against you. So that is why we introduce negative delta, and we sell the same type of call, a call or a put, one or multiple clicks away from the current position of the option contract. I like to usually just sell the next one out on calls, but on puts, I like to sell a couple away, and I don't know why. I've only done this like a few times, so I'm still figuring out what works for myself. But this works really well, actually, because what it does is it lets you, in an emergency, true emergency, you can exit some equity without disrupting the trade. And that's so much easier than selling at a loss. It's like 1,000 times easier. Like if you have a mental block of selling at a loss, it's going to be so much easier for you to sell for a credit, because you're like, okay, I get the credit and then I can buy it back. And guess what? Like one of these trades I did was pretty good. This was a debit, but so this trade, I was going to tell you guys, I forgot about how I failed here. I just show you. Sort by quantity. My highest quantity was at my lowest price. That's what fucked me. I could have sold the same quantity a few minutes earlier for $2, or later in the session for almost the same, but I sold at the bottom. And the reason I did that is because I had to manage risk. Like I had opened myself up to too much risk, and I knew that there was a very real possibility that I was going to lose my entire collateral. And so I just had to sell and take a loss. And so the lesson there is like, don't get yourself in that position. Don't get yourself in a position where you have to sell. Always operate from a position of strength. And the way that I've learned to do that is by always pairing my contract with an inverse contract. So if I'm going to have a call or a put, if I'm going to buy a call or a put for a debit, I'm also going to have another call or a put that I'm going to sell for a credit in the same chain, so I can collateralize them. And then I always go deeper out of the money on that one, because usually, not always, but usually, because I don't want to have to add any cash collateral or whatever. I want it to be collateralized by the value of my existing contracts. Now, when you're doing that, just as with selling a covered call, you're removing the equity from those contracts. And if the price moves against you, you're screwed. So nothing's easy. Like you're just introducing more risk. But if your risk is way off sides, you're actually introducing a ton of balance, because what you can do is a double move that I hinted at before, which is you sell a call for credit and you use the premium to buy a put for debit. So like immediately you can change the delta, you can invert the delta profile, but like, you know, in a second, in like 1 second, you could just be like, fucking invert it. You know, it lets you react really quickly to price changes. Now, are you actually going to have the wherewithal to do that at a time where it's not super painful? Because it sucks to do that at the bottom when you're forced to do it. This is what it looks like. I was forced to do it here. And because of this, a trade that netted like 5 times less than it otherwise would have. And it was like, oh yeah, I think I say on the title. So this trade would have been $6,500 if I could have not done these 3 trades here. These offenders are what got me. And had I not done that, and had I sold at a better time, but I was forced to sell. I had to sell, because if I didn't sell, and what's funny is if I didn't sell, then I would have just like made way more. But if I didn't sell and Tesla went down instead of up, I'd have been so screwed. And so I just had to manage that risk. It wasn't an option, because I know what it's like not to manage that risk, and you can lose your whole premium in like 2 seconds. That's how quick these contracts change. And so that's why I was forced to sell, and it sucks. But like, I know that it's better to do that than, you know, lose the fucking whole collateral. And the trade was still profitable. And so we can see why that is, probably by sorting by price. And I bet I will these are something, these don't count, because this was like early in the day, and I think I just exited a trade and I was like trying to put it back on. I sold those. I wonder how those impact my cost average, because I swear I should have had a better cost average on the buy side, because I did some good buys, I thought. But we can look and see if I'm lying. Well, to do that, we would do this. Okay. So these are okay buys. That's pretty good. 5 units at like almost the lows. That's pretty good. But like this is the exact opposite of what you want to see. You don't want to see any green when sorting by price descending. You want to see only red. That's where you want all your debits. I have my biggest fucking credits closest to the bottom of the price. And I know this shit. I've talked about it on this show. Now we know why these exist. But still, like, this is why the trade worked for me. Probably these buys, if I could have made them 15s instead of 5s, then again, the whole profile would have changed. But it's so hard to do those buys, because to do those buys, all of this is like a microcosm of years of trading. Like, to do those buys, you have to be in a good position. Like, you have to be totally stable. You're not taking on wild risk. You're not taking on more risk than you can manage. Well, the only way you could do that is if you didn't buy yet. Well, you probably did buy, because the only reason the price got this low is because the buyers got exhausted, and you're probably one of those exhausted buyers. By exhausted, your ammo's gone. You used all your fucking munitions already. And so, like, how are you actually going to make this buy? You do it in one of two ways, which is you have some way to know that this is not the right time to buy when everyone else thinks it is the right time to buy. And that can be for technical reasons, for order flow reasons, for whatever, human psychology reasons. And that way you're buying at the right time. So you have the right entry point. And then again, you want to do that in volume. Now, you wouldn't want to make your first buy in volume, but still. Then what? That's the buy side. There's another side. I can't remember it. If it matters, it'll come back. And so the point is, you want to do your highest volume buying at the lowest prices. You want to buy low and sell high. But so often, even people who know what to do get the shaft because they did something wrong. And in my case, what I did wrong is I opened too aggressively, which is I'm want to do. And so my opening bid was way too much. And then my follow-up bid was like 3 times more than it should have been. And then 5 times after that. And so when we got to the bottom, I wasn't in a buying position. I was in I have to hedge position. And which everyone was in. That's how we got that low. So it's not just me. Like, nobody has money at the bottom of the market. Only people get paid when the market's up. Like, that's how it works. That's how margin works. That's how options work. That's how it always works. Now, if you're a seller, if you're a bear, then you have money, but you don't really know what to buy or do with that money at the bottom of the market anyway, so it doesn't matter. You want to be a bull that has money at the bottom of the market. That is the primo position. Or a bear that has money at the top of the market. But either way, most of you all got squeezed out by whatever side you're on, because you're too much on that side and you're not just going by like the flow, and you're not letting the price guide you. One moment, if you don't mind. So what I have learned to do, the worst mistakes I've ever made investing, and I can say this unequivocally, and you can save yourself quite literally millions of dollars by doing this. Don't be a bull on bear day. Why? Why would you spit into the wind? Don't be a bear on bull day. Here's what you really shouldn't do. You really shouldn't be a bull in a bear market for like a couple of months. That's how you can drain a lot of equity. What you want to do is go with the flow, because who fucking cares? You don't know what the price is. Nobody knows what the price is. That's why we have a market, is so we can trade around and figure it out. Like what? Somebody knows? Like even this Morgan Stanley upgrade, I appreciate it. He doesn't know. Nobody knows. We can model the price based off of our predictions, right? And those are ostensibly more accurate than astrology sometimes. But still, nobody knows what the price is going to be. Nobody can know. And external forces can change everything in a second. So it doesn't even matter if people had an idea of what it could be. Their models can snap apart by an unconsidered externality. Nobody fucking knows what the price is going to be. Nobody can know. And except the colluders, they can know when they get together and they short sell and they, time their efforts together and pump and dump. And we see that happening all the time in markets. Here's an example of it on the order flow. They're pumping and dumping on SPY and QQQ today. They do this every day. So every day they're doing some kind of giant pump and dump where they're buying up the companies or they're hedging the ETFs or vice versa. And they're like using, I don't know, this is speculation. I would like to talk to somebody who does know. But this pattern is very stable. And it's that on days where there's a ton of call volume into SPY, there's going to be a ton of put volume into Q. And the major big tech companies are also probably going to be pretty bullish. Let's see. I don't know if I'm missing anyone. Who do we got? Whatever. That's enough. Yeah. So they're bullish. So they're buying the individual names and they're, I believe they should be putting the Q then they're putting the Q, but then they're buying up the SPY. So anyway, like something is happening and like retailers definitely don't know what the price is going to be unless they're on Wall Street bets. But even that, nobody really can know because Russia can invade Ukraine and, like there can be some insane, amazing breakthrough in AI or anything can happen. Anything can happen to the upside or the downside. So bears and bulls alike all share that risk. And so the trick of it all that I've learned, and it's a hard trick to learn, and I haven't learned it, but at least I know now it's the trick, is you want to have money when nobody else has money. That is where all of the wealth is generated. And so when no one else can buy, you want to take your time. I think that's what Warren Buffett is probably pretty good at. But like human psychology and just the market's trend and everything is against making that happen. And so you have to have an edge. And my edge is in part like sharing my failure, which is objectively valuable to people. And it helps me not do it again. In theory, I don't want to have to report to you guys stupid shit, right? Like I want to report good things. But yeah, like how do you actually overcome human psychology? GDT had a note on that. Let's see what he said. Psychology plays a big role in trading. FOMO can make you want to buy when prices are high, and fear of losing out can make you sell when the prices drop. In my case, it wasn't fear, it was risk management. I had to manage that risk because I've not managed it. And what happens is 1,000 times worse than, just like taking the small loss immediately. Okay, here's a different way to think about it. Consider using tools like moving averages or other indicators to help take emotions out of the decision. Right. That way you rely on data and trends. Exactly. That's a great point, GDT, Gamma Delta Theta, MyLLM. He always has good points. We let the order flow tell us what to do. We're not going to kick against the pricks, as it were. I'm not going to go and I wanted to be a super fucking bull on Coinbase today. I wanted to. I didn't. I just made a couple of buys. But I wanted to like freaking liquidate for Coinbase. That was my gut instinct. But I couldn't justify it. Why? Because I just didn't see anyone else doing that. Like nobody was playing Coinbase today. So I just felt like it wasn't the day to do it. And maybe I was right or wrong or whatever, but that is literally why. If I would have seen a ton of calls coming in, I would have been like, let's go, fucking yes, we could go look real quick at the dark pools. I said we wouldn't, but we can just look for coin. Okay, so nothing happened the whole day on coin. Now, that's how it is. Like, not every stock gets called every day. Whoops. I think we want to be on that. Yeah. And yeah. So I guess before I close, I just want to recap on a few things, and we can look at the highest premium. The few things are, if you're going to be playing with these expiring options, which is what all the options that people buy and sell are, like go to the QQQ. Oh, it's all for today and tomorrow, basically. Especially at the start of the day, but yeah, all today. And so this would be good training for me, actually, to just copy exactly what they do on QQQ verbatim. I'm going to try that. Because look at all this put flow. I suck at buying puts. I got to practice it. Anyway, so yeah, like GDT said, you want to find a way to take emotions out of it. You want it as much as you can. And I think the way that that's best done is by having a lot of good indicators. The Bollinger Bands are one of my favorites. The Blue River there. The RSI, the purple, graph at the bottom, below the volume bars, the red and green volume bars. That is also a great indicator, I found. And between the Bollinger Band and the RSI, you got a pretty good indicator. Now you couple that with order flow. Damn, that's pretty good. Now you couple that with your own price history of knowing the stock. Okay, we're 4 for 4, high volume buys. I've never done it. I've never been in a position to do it, because whenever that happens, I, like everyone else, am out of money. I already deployed my buying power, and I only get more buying power if things go up again. And so I just got to sit there and wait for that. But yeah, anyway, the trick of it all is you want to have money when nobody else does. And that is where you generate all the wealth. And I think the way that you can get there, if you want to not take a shortcut, but if you want to take a ton of risk and you think you can handle it, you can't. Maybe you can. I don't know. Why would I say that? But the way to do that is by doing what these guys are doing, which is buying options that expire today, because they're the most volatile. I mean, on the QQQ, this is what got me addicted to the gambling aspect of this stuff. Although I wouldn't say it's gambling. I'd say it's gambling like poker is. It's not slots, it's poker, right? There's skill and chance involved. And that's why, I had another idea I wanted to tell you. Well, I'll see if I can remember to come back to it. And so, look at what these guys are doing. They're putting millions of premium. Let's see. 1.8 million. Well, those are safe. Those are all safe. But, okay, this is a risky one. Let's just go like this. Expiry time frame in 1 week. Let's say 2 weeks, because that's still pretty risky. $1 million into Friday. Boom, right there. This guy's putting $1 million on the line. That contract, I know. The 272, okay, that's in the money almost. But he bought it out of the money. That is a contract that if nothing changes, that $1 million evaporates in 2 days. And I don't even think Tesla finished that much above 270 to begin with. Whoa, they put that into close. So he's expecting a gap up. Damn. What if we gap down? You're crazy. Oh shit, we're going to gap up. I think we're going to gap up. Let's see what the order flow says. Oh, that's not consensus. Okay, well, anything can happen tomorrow, but it was super bullish today. We might gap up though. But yeah, like look at what happened in the beginning of the day. Like they're just deploying 50K, 25K, 100K, 50K, 75K, 125K, 35K, 500K into the fucking market, YOLOing it into contracts that are the riskiest possible. I'm not saying they're YOLOing it. I bet they have good systems to manage the risk. Here's a good system. If the trade goes against you, immediately sell a credit. Immediately. And then you have the credit. Now, coming back to like, there's too much to talk about. Coming back to why it's important to sell credits. If you're going to be buying something, you got to sell something. I heard wise words on Tasty Trader, I think it is. And the reason that is in this world, and the reason for that is because through like a blip in the system, your contracts can evaporate, right? So they got to be secured somehow. So what you do, and this is fun, is you bet on whatever you think is going to happen to start. And if you're right, you let that ride, right? Now, let that ride until it gets some significant gains, which I'd say like 20%, something like that, which like most people would be thrilled to have like money improve by 20% in a year. Like we're going to have that happen in about 3 minutes. Now it's going to fall by 80% in the next 5. So that's why it's fair. But those 3 minutes are awesome. And so how do we lock in those gains? Well, we took on a risk. We bought a debit and opened a position. We don't want to close that position because we think there's way more upside, but we want to lock in those gains. So what do? We sell a credit right above it. And now we have capped our returns and we've opened a credit spread or a debit spread. And so the upside is all in our favor. And if things go down, we'll realize some gain. We will realize some gain because we would be able to let the other contract expire worthless or buy it back at basically nothing and then sell the remaining. Anyway, it's way more safe. I'm not sure if it's like, it's not risk free or whatever, but you're definitely locking in gains that way. I really think that you are realizing gains. I just can't think of why. Now, you're not realizing gains if you're underwater and you sell a credit while your core position has a negative return. You're locking in actually losses is what you're locking in. And so, but that's the trick is like, how do you not lock in those losses? Well, you had to be a call seller when everyone was a call buyer, and you had to be a call buyer when everyone was a call seller, and they were wrong, right? Like you had to be right in that action. And so, yeah, Tesla in the morning, just tons of calls coming in basically all day. We get some puts and then it's kind of mixed. And then there's a long call streak and mixed, more calls, big money calls coming into close, big money puts coming into close, a lot of money coming on the chain, which is going to increase vol and prices, I think, right? Here's what I know. If you want to play contracts with these guys, you can't fucking use naked options. You have to cover the other side of the trade somehow. You have to introduce negative delta. And the reason is especially true if you're using out of the money calls, which they always use. Like they do use in the money calls, but definitely they prefer out of the money calls. Why? The price change for even just like 3 clicks is pretty crazy from compared to in the money. And then the also price change at like 5 clicks is like it's like 10%, 20%, 50% price change movement. That's why they use out of the money for sure. And so they take on this tremendous risk. And the way that we balance the trade then is by getting all of our indicators flashing green before we act. I never do this, but this is how we should do it. There should be an easy way to see the RSI. But if you waited for all that, you would never, it's so obvious anyone would know to buy. And so like you do have to take some risk. But like the point is you can do it safely if you sell a credit. So like let's just walk through the day real quick and then we'll be done. So you come in and you're like, I'm going to try to scalp some Tesla today. That's what I want to use my time for, which is what I did. Why? Because it's freaking fun. It's like better than any real-time strategy game out there. It's better than a casino or StarCraft combined. And I played a lot of both. And so we come into the day, we got this intro put. I'm not going to buy a put yet because that's one put. Like, let's get 3. We get 3 puts, I'm buying puts. Okay, there it is. We get a call. Call. Okay, we're at 3 calls. Let's fucking go. Load up on calls. And so we just call load as much as we can. And had we done that, that would have been the perfect play. But I don't think I did high volume. I was too nervous. I was just testing. As we saw, actually, I did my highest volume selling. It's all green. I mean, I would have bought a put on this for sure because this would be too long of a green streak for me. And then, yeah, like here I'd be selling calls and using the premiums to buy put. Now I'm capping some upside, but it all worked out. But again, had I perfectly followed the order flow? No. So how did I not perfectly follow it? Here's how I failed. I didn't fail. The trade was profitable, but here's how I got a less than a 1x when I could have got a 5x or a 7x. I think here is where I did my high volume buying. I did my high volume buying at like not the earliest spot price. I did it at like above like after the contract had its move, because these contracts, they have these levels. It's hard to explain, but it'll be like at like 80 cents and then it'll be like at $1.20 and it'll be like stuck at 80 and stuck at $1.20 and nothing. It never is in between. It's weird like that. Like, and that's how you get trapped in the box, is like the price can go up and your contract can still lose value if you're on the wrong side of like one of these like price levels, according to whatever indicator is influencing things. So you really need to have done your accumulation before that pop. And that's on puts and calls. Same exact way. Like if you buy I've had puts that I bought like a second before for like 25 cents that exploded into like $3-4. Incredible. Had I known that they were going to do that, I would have bought a lot more. But then I've had the opposite where like you can buy a contract and you can just like get a bad entry point, or the price spiked right as you bought it or whatever, and you're underwater 10% on that contract from the second you open it, and it just only loses value. So like that's why we sell credits, because that can happen all the time, especially with these 0 days or 1, 2, 3 days to expiration contracts. So that's kind of how I'm trading things these days. And I guess the goal is to make money, but it's not really. The goal is to see what's possible. That's the goal. And I think some amazing things should be possible if I can fix my behavior. So I am a buyer. Like, again, it needs to be the exact opposite of this. When the price is at its lowest, I need to see these 10 and 15 numbers in the red, not in the green. That's what I need to get. And I will give myself credit for these because that's pretty cool. And this is pretty cool. And so, but you want to know what happens is your buys fail. Like half of the time, and I still have to fix this with technology, but I will be able to fix it, is the buys don't execute because like I just missed the price. And I'd be happy to pay one click higher, but like how can I reorder in time? And then the price escapes, and the move from 115 to 130 takes like a second. I mean, we could probably see it in the numbers here. So this contract, 819, 121, by 8. Look at that. That's evidence. Wow. Wow. So within 1 minute, the delta on this contract is $7 in real cash. Incredible. Right there. You see it right there. Well, that just shows the volatility, which is like almost 10% of the contract or whatever. And that's just a random fluctuation of a random contract. That wasn't even anything. That means that in the final seconds of 819 compared to the first second of 820 is interesting. That $3 jump needs accounting. How does that work? In fact, let's do this. I don't think I've ever done this. Let's look at price by time. So when we open up, we're at 187, which is crazy. So we gap up. And these are some nice sells. That's good. I know what these buys are. These are kind of mistakes. It's not technically a mistake. Okay. So I'm being a buyer as people are being a buyer. That's good. And then when do I sell? See, this is dumb. Why am I selling here? Look at the range of these sells also. So here's a sale 30 minutes apart. Here's a sale 5 minutes apart, $20 difference in contract value. That's $100 right there. That's crazy. If you count this, that's like, $200 or more. $300. Oh man, that's crazy. So I guess I ended the day. My exit was what? Oh, that can't be right. Why did I do that? I do remember why I did this, and it was to put the premium into a different contract. That's why I did this. But also it was because I just bought these, like this trade right here is localized. So my cost average here is 124. And then my cost average here is 121. So $3 a contract. So $30. Anyway, I just got out of the trade to like go do something else with the cash, basically. But yeah, like these are the egregious. No, not those. Those are good, I guess. This is an egregious. No, that actually doesn't count. We should go like that. These are egregious. This one in particular is bad. 129.15, 129.30. And I also remember trying to sell at like 136 and I couldn't get the trade to execute because the price was falling too fast. And speed and execution is everything. Like you need a button that guarantees fill at the lowest possible price. That's what you need. And I'm not even close. So lots of room in my trading hobby that I like doing to improve in both speed and accuracy, which is exciting because that means there's lots of headroom for us to grow and improve our margins, as it were. Yeah, I don't think I did any other real trades. I think these were losses, but I also wasn't trading it. Anyway, cool. So, yeah, that's what you always want to. Oh, I could show you this actually with the credits. I think that's what I actually came here to do, is to show you the credit side. So this is a contract that I was selling a little further out of the money, and I was collateralizing it with the previous contracts, which I was locking in returns. And so when those contracts had like 10, 20% return, I would sell for a credit these contracts. And then I bought them back at the wrong time, but like I could have anyway. Again, profitable. I think it was profitable. But still, it was definitely profitable because imagine the whole thing went against me and like the whole trade blew up in my face. Well, it couldn't really because I would have sold these for credits. But just to give you an idea of how this works. So the time here will be interesting. Sell. Okay, so we see a lot of selling. Why am I selling this contract in the morning? What the was I doing? What the Okay, this is embarrassing. I didn't look ahead of time. Oh no, this is such a bad example. Damn. Oh, this is okay. This is good. We like this and this. Wow, and this. Ooh. Oh, that's great. But like, what's the time? Okay. I'm going to guess that what's partially happening here. Why? Why? I think maybe I was paranoid that the price was going to fall. I don't know. This is crazy. Why am I selling first thing in the morning before I've accumulated? I know because I had previous days inventory, but this is after that. That's some crazy shit. I'm going to have to think about that in the next session before I sell. Is like, why am I selling right now? Why not open a put instead of sell a call? But either way, I did this one all wrong because like all the green is at the bottom of the price. Let's go look at the top. And it's the exact wrong. Oh my God. Now these I can kind of excuse because I was clearing out a position. And I think like there's a reason for those outliers, I guess you could say. Okay, well, this is pretty good. Wait, I think in this case, I do have it correct. No, I have it wrong in both ends, or I have it right. I'm selling well as well. So the reason this trade was somewhat profitable for me is because I was selling at the top. And it just so happens that it was probably pretty unprofitable for me in the morning to do all this selling. And then I probably had to buy that back at a loss. But I know that the trade was net profitable. How do I know that? We can just go like this and go. Well, anyway, I don't have to show you my work. You can believe me or you don't have to. But yeah, the trade was profitable, but it was like not worth the effort at all. Like nowhere close to worth the effort. But it would have been worth the effort had I just done a couple of things different. And that's kind of like, maybe a metaphor for life. It would have been worth the effort had I done a few things different. You're going to spend the effort. It's going to be hard. But that's regarding life. I think this is a pretty fun way to play markets. I like thinking of it as a real-time strategy game. So today I was playing Tesla map, and I like playing Tesla. It's like my favorite map. I like playing Arc is another fun map. Maybe you guys want to play sometime. We can get a live stream chat going, and we can do some live trading where like on the screen, we can get P&Ls going and basically I want to build a way for the internet to buy me a risk-free option, and this whole thing is a scam to make that happen. So let's hope I get there. Thank you guys, anyone who's watched this much. Good guy or girl, could be a girl. All right.